Welcome to your next edition of Highlights, our ongoing education for those of you in the candlecharts.com family. And today we're going to look at a couple of aspects. Okay, first we're going to be looking at the crack and snap. Okay, just to refresh your memory for those who don't remember what that is, it's a support area tested at least twice, as shown here in the circle. And then the market breaks under support either on an intra-session basis or even holds under it for a close or two. But the snap back comes when the market gets back above the prior support area. Okay, so right over here. And what's nice about this is you have a target to the most recent high, in other words, where the sell-off began. And if the market is solid, it should not get under the low here. So let's look at an example. So in this case, we have a support area, a couple of sessions back to back. And notice the market broke under it marginally, but it is a break of support. And then what happened the next session? Although we had a bullish engulfing pattern even before that, as soon as it got back above this top line here, because this was a support zone, which the market broke under, as soon as it got back above here, right around 122.20, that is a crack and snap. And the stop would be down here, and the target would be over here. But as you know, one of our key concepts is the importance of the overall technical picture. Okay, so some of you may have seen this cartoon we use quite frequently. To know where you stand is as important as candle pattern recognition. So here we have the master chair maker, and this poor apprentice obviously did not know how to use the tools correctly. And the master says you must learn to properly use the tools. And with this concept, no matter what candlestick signal or no matter what problem example of a Western indicator, and in this case we're looking at the crack and snap, you always have to take into account risk reward, a vital trading concept. So let's refresh your memory what risk reward is. Reward is your profit potential, whatever your target is, and risk is the potential loss, whatever your stop out level is. So risk reward, if you say you're buying a market at 100, your support at 60. So in other words, your stop out area, support at 96. So say you're risking to 96. Say this is support area at 96.25 or something, and you're going to do it a $0.25 under that. So let's say support your stop out, your risk is to 96. Your price target is 108. So you're risking 4. Risking 4 to make 8 gives a 1 to 2 risk reward. So now let's look at this in the concept with risk reward. And by the way, this should be R/R. Instead of a question mark, it should have been a slash. So now we're going to be looking at the crack and snap, adding the concept of risk reward. And we have to think about, is this a good trade? So here is the crack of support. Here's the snapback right over here. And what I did here is this was a potential support area. Okay, this is the low here. The market should not break under that. And the most recent high, in other words, where the sell-off began for the crack and snap, is your target. So with this concept, we would think about buying. This is obviously a 4x. We'd think about buying right over here around 122.20. As soon as the market got back above the broken support area, our stop would be a little below the lows here. So I'm figuring our stop would be around 121.40 down here. And the target would be a couple of pips below here, just kind of rounding it off, okay, to around 123.40. So our risk is 80 pips. Our reward is 130 pips. So it'll be very subjective if you want to decide to do this trade. Normally we like to have it at least a 1 to 2 risk reward. So in other words, our risk in this case would be 80. And our reward, ideally, we'd like to be 160 pips, but this is pretty close. But the main concept is no matter what the candlestick signal is, or no matter what Western indicator you're looking at, say this was a hammer, the same concept. Say this was a hammer, and let's imagine the hammer closed over here. This was the lower shadow, and this was the top of the hammer. We would not do this trade because if you're buying it here, assuming this obviously is not a hammer. That's actually back step. Let's say you're not using the crack and snap. Let's say you want to confirm a bullish engulfing pattern, which this did. So the confirmation of the bullish engulfing pattern would be over here. So if you bought it here, and your stop would be here, and your target would be here, is that a good risk reward? And the answer is no, because that's probably 1-to-1 or even less than 1-to-1. So always look at the concept of a candle signal or any potential trading signal in the overall market picture, especially with risk reward. Now, for those of you who want to continue your education, you may be familiar with our Candle Charts Academy. This is a link, www.candlechartsacademy.com. For you students who already are members, this is a free member site, and we are always adding new information. So for current students, be sure to log in here. This is what the startup page looks like. And for those who are not students, look at all the information you can get for free. Hundreds of dollars worth of information. My most important trading rule. Actually, we kind of addressed that with risk reward. I go into a lot more detail. The 4 common and costly mistakes almost every trader makes, and lots of other free stuff. So for those of you who don't have all this free training, go to this link now. For those of you who do, be sure to log in because we have lots of new information. Okay, thanks for joining me.